Today, folks, we're on that cusp of the interest rate cut cycle with $6+ trillion sitting in money market funds, not including high interest savings accounts, GICs, and bonds that are yielding upwards of 5+% that are no longer going to be sustaining those yields as the interest rates slowly start to come down. That money is likely going to start looking for new places of income and return. And there's a lot of speculation that that money is going to float to the bottom half of the market. And we are actually seeing that speculatively in real time before the interest rate cut cycle even begins. Now, I am personally placing a bet on this. Now, I do not have a crystal ball, but for the last 2 years, people have been telling me, why would you buy dividend stocks when they've been underperforming the market? And we are going to talk about the actual performance and how underperforming they have been and what the possible future is I don't have a crystal ball here, folks. I am, speculating, but it's like the safest way you can possibly speculate because they are highly stable ETFs that remove a lot of volatility from the big tech companies. And we can see right now, tech is lacklustering against the performance of the lower half of the market. So the ETFs we're going to be talking about and comparing is everything against VOO when it comes to the Schwab US Dividend Equity ETF, my utility ETF that I recently started buying. We'll talk about VNQ, the Vanguard Real Estate ETF, and VDY on the Canadian side of the border. And it's going to be really interesting. The data behind this is going to be fascinating. And if we take a look at first and foremost SCHD, only as of recently has this really started to pop off. I mean, it is now up 8.5 or almost 8.6% just within the last month and a half, 2 months. And I think this is just the starting point. Now, if we take a look in my RRSP, I currently have, about $60,000+ sitting in this. We'll take a look in the actual account to see what it is with the capital gains because it is up a lot since I've been buying it. And a lot of people were fear-mongering me out of this ETF, saying it's terrible performance, it's not going to do well, the high interest rate environment is going to kill it, but I just kept cost averaging. And now we're looking at the future being like, these stocks are going to benefit substantially. And I plan on pulling these dividends out long before, I'm 60 because I want to fast track my financial independence to one day retire early in the next 5 to 10 years max. So I really want to take advantage of this ETF while the yield is higher. And currently I'm getting $2,666 US that I'm constantly reinvesting. I don't have to pay any withholding tax on it. So it's actually saving me an extra 15% on this income that is just, again, reinvesting that, I'll have to pay tax when I draw it out. But in the meantime, it's just going to keep accumulating. And if you're on a path to financial independence to one day retire early, consider subscribing. Join me on that journey and hit that like button while you're down there because I have a few checks that I have to go through when I'm buying ETFs. Like I'm very frivolous when it comes to the expense ratios, the past performance, though it does not equal future return. I like to know that management has done somewhat of a good job or the mechanism of action controlling the ETF fits, my passive income strategy. But with 0.06% on the current, expense, it's non-existent, right? This is why people love this ETF. You're currently getting a great starting yield at 3.68%, which is super, around 3.5%. The current return, and I really like this performance because if you go back to 10 years ago in 2014, you invested 10 G's, you're up to 30K right now, right? And if we just take a look at the holdings, and we scroll to the bottom here, I absolutely, and I would buy these on an individual basis, love these stocks. You got AbbVie, nothing wrong with healthcare. Lockheed Martin in the middle of geopolitical events that have really been treating this stock well. Home Depot that's been somewhat suppressed for the most part because the real estate market has just not been doing as well. You got BlackRock. Who's going to go wrong with BlackRock? You got Coca-Cola and Pepsi and Bristol Myers. A lot of people were concerned because they removed Broadcom and some of the chip stocks, but honestly, I think that was an inappropriate decision because they are highly valued here, and this ETF's goal is to stabilize income, get good income growth, and I think that was the appropriate decision. I think this is probably one of the best places to collect income in retirement. Financials at 17, healthcare at 15, consumer staples at 14. These are probably the best stocks you can own in the US if you are an income-oriented investor, right? And if we take a look, again, I got about 67,000 currently. I'm up 12% since I've been buying it. So now I'm kind of getting this combination of not only a higher yield than you're going to get, because I've been buying it for a lot longer, I'm sitting in a much healthier place, and a lot of people are getting kind of gung-ho about this ETF. Even though you go back several months ago and people are like, I don't want to buy this. I don't want to buy this. Look at it. It hasn't done anything here. It's been super suppressed for the last little while. But if you bought these dips like I've been doing, you're getting a pretty substantial return right now, right? So that's SCHD. Now I'm going to flip to the other counterpart that I talk about a lot here, which is VDY, and then we'll talk about utilities and REITs and what it means for the interest rate cuts, right? Because VDY, you know, this one recently has been just crushing it. I mean, 9.2% year to date, plus you're getting probably closer to a 5% yield if you were buying it at the beginning of the year. I mean, you're talking about 11, 12% return here, so long as it remains stable for the rest of the year. I mean, this is awesome, right? For dividend ETFs, since when, right? People thought these were dead in the water. So VDY, I currently have about 33,000, and between me and my fiance, some of these stocks do overlap. So we do have a lot more in here. I do keep it at a relative smaller position because I'm more proponented to the S&P 500. It makes up 50% of my portfolio. So I'm always kind of comparing the performance between these 4 ETFs. But with 33K, that most of that was profit coming out of Tesla. A decent chunk of it was a nice, healthy chunk of profit that I'm very happy I transitioned over here, because now I'm up 4.4% since I sold Tesla at the 250, 260 mark, and we're continuing to see just continued gains, which is awesome. Again, 0.2%, my bleeding limit of how much I'm willing to pay, because once you get into 0.3 or higher, when you talk about a decade out, you're really giving up a lot of returns just to management, which I hate. This is a monthly paying ETF, which is awesome as well. And again, this is where things get interesting, because if you look at since inception, since about 2014, just before maybe 2012-ish, I mean, you're talking about a $10,000 investment turning again into almost 30 grand. It's not nearly as good as SCHD, but still, I mean, this is awesome in my opinion. These are where the returns that I look for. Very healthy. I mean, you're over doubling your money every 10 years. A lot of that is paid out as income. And if we take a look at the holdings, I do not recommend this being a huge position or a priority position in a portfolio, because I believe if you're not retired, you don't need dividends today, you're going to get into that situation of what they call double tax, because unfortunately for these dividend stocks to pay these dividends, they have to pay income tax on it. Then they give it to you, and then you have to pay income tax on it. So you want to make sure you're holding these in tax advantaged accounts to obviously avoid, as much taxation as possible, which is why it's just not a huge position. But I also don't want it to be a huge position because it would over-concentrate me into financials. It's the one reason I love this ETF, and it's one of my biggest concerns, right, if you're overexposed, because 25% of your money just sits within Royal Bank and TD. Now, I love these two stocks, but if I made it like a 30% weighting in my portfolio, even if I had 50% in the S&P, Royal Bank would still be a bigger position than Apple would be, or Microsoft, because they're just, Apple and Microsoft are what, like 6-7% weightings max in the S&P 500. So you got to be a little careful with the weighting exposure. I want bigger exposure to tech still within the S&P, but I mean, it's nice kind of just understanding that. But I do love these like Pokemon cards. I collect them all, and I use this ETF to collect these banks because, again, I treat them, as probably one of the most stable dividend-paying investments globally. The Canadian banks are world-renowned for their stability through rougher market environments, which I think a lot of people, if past performance does matter, I don't know why everyone's shitting on them now when they've been doing so well in this tougher market environment. So VDY right now is paying me about $1,428, about 120 monthly, which is super awesome. So we'll talk about XLU and VNQ, because many of you know on my live stream, one of you recommended XLU, and I actually sold my US real estate ETF in favor of the utility ETF, right? So we went from real estate to utilities. Let's talk about why, and I'm still bullish on both of these ETFs. So utilities with XLU, this thing has been, keeping up with the S&P 500, which is mind-boggling to say the least. But I think a lot of people are recognizing right now with cloud computing, AI, hybrids and EVs, the energy demand is getting stretched, and we need a lot more energy consumption. And where are you going to go for that? The utility sector, baby. And these have been largely suppressed because they are interest rate sensitive stocks. They have a lot of debt, they have a lot of infrastructure, and as we head into the interest rate cut cycle, not only do you have the perfect storm, the tailwind of energy consumption expanding dramatically, but now you're going to have lower cost construction. They're going to see their debt start to come down in monthly payments and all that. So I'm very much looking forward to see what the performance is going to look like in the coming 1, 3, 5 years, right? So if we take a look at this in and of itself, again, a very boring ETF. I call it a grandpa ETF. You're getting about a 3% dividend. Again, the expense ratio is non-existent at 0.09%, which is beautiful. Checks all those lists. And if you take a look, you got NextEra Energy, Southern Company, Duke Energy. Again, I've talked about these in the past. You're getting exposure to literally pretty much the entire utility grid, everything from nuclear to the things we don't like coal. But the fact is we need them. And the companies that are going to transition this are going to be these guys, whether it's renewables, doesn't matter what it is, they're involved in all of this. So I love this ETF because I don't have to pick Southern Company over Duke, and I don't have to pick 3 or 5 stocks I got to be buying, and like a squirrel without a nut, you don't know what you're buying the week of, and then you get a little worried when the earnings don't look that great. That's why I like passive income, and that's why I like these ETFs, because they make it truly passive in a sense. I am not managing it, right? Which is beautiful stuff. So that's the utility sector, and I chose it over V and Q because of the tailwinds and the fact that I have overexposure to real estate. I own a condo in Toronto. I really just don't like plummeting on, so many different pieces of the same sector. So I thought it was an appropriate switch for me. But keep in mind, like our family does hold this ETF, and we have been buying it. And look at it recently, again, heading into the interest rate cuts, the thesis is playing out. You're going to get higher than average returns if you've been buying the dips, because there's speculation with, good reason that these things are going to start to perform better and cash flow is going to start to increase. Now, is this priced into the stock already? No. There's going to be volatility for sure, but we're talking about the next 1 to 2 years of interest rates continually coming down. I'm speculating on that, but I really believe that we're going to end up below 3% interest rates again because it booms the economy. And does it affect inflation? Not really. I mean, interest rates were at like 0% for a damn near decade, and the market boomed. And it really didn't cause a whole lot of inflation until the government was money printing like crazy. So if the government's not money printing, they're doing their tightening cycle and they cut interest rates. All this is going to do is open up margin. It's going to open up money market funds to reconsider where they're going to get the best rate of returns. I mean, when margin's under 5%, folks, this stuff starts looking very attractive. So V and Q, I mean, you're getting exposure to all the same stuff you would be getting exposure to with that utility ETF and a lot of these ETFs, because again, you're getting exposure to, look at the sector exposure here. We're talking about data centers making up 8.4%. So whether you own the energy company supplying the energy or you own the REITs that, own the data centers, it's really interesting, right? With healthcare and obviously my favorite industrial sector with a 0.13% expense ratio, it was close to a 4% yield, probably under a 4% yield now. I love this ETF a lot. All of these, I think, really play well together because the S&P 500 severely lacks exposure to utilities and REITs. That's why I started seeking out these ETFs. But again, with a squirrel without a nut, it's really hard to build a portfolio of all these different sectors and manage it correctly. And I see so many dividend investors owning 40 or 50 stocks, which is just, clueless in my opinion, because you'll never manage it correctly and it always leads to underperformance over the long term. So let's talk about performance of these ETFs, because I think they're going to start to excel performance. Again, interest rate cuts, real estate's going to boom. Home Depot, I see so many effects in all these companies. So the S&P 500 is up about 92% in capital gains. Keep in mind there's dividends over the last 5 years. We're looking at the 5-year chart here. So you got to tap on 1.5% over 5 years that the S&P has been paying on top of that. So I mean, you're probably closer to 100% return in 5 years, which is just insane. It's why I own the S&P. But then let's take a look at the Schwab US Dividend Equity ETF, which kept up for the S&P performance until about the second quarter of 2023, and then finally it started to lack a bit. But when you slap on the fact you've been collecting probably a 4% yield over the last 5 years, like I have if you've been buying it back then, I mean, you're talking about a 57% return, plus you can tap on an extra 15%. That takes you to what? Maybe closer to 75, give or take. But keep in mind, it's been lacking performance because of the market environment. So I'm speculating it's going to start to outperform. Same, let's look at VDY. I like VDY a lot too, because over the last 5 years, if you've been getting closer to a 5% yield, you can tap on, an extra 25% onto that 42% return. So that takes you to 40, 50, 65, 67%. I mean, that's pretty good, right? I mean, that's really awesome. And the performance starts to look really good when you zoom out, especially if you think these stocks are going to start doing better. So then you look at the utility ETF, which is really lacked in performance. You look at the V&Q, the real estate ETF that is really lacked in performance, and past performance does not equal future returns. You can't look at these charts and be like, oh, they've underperformed in the past, they're going to underperform in the future. It's like with the tailwind of growth ahead of us, and again, these being highly interest rate sensitive stocks, you have to imagine, and you can do the calculations yourself. If you go into these companies and calculate what they're spending on debt, like I do with the telecoms and all these stocks, you can see they're going to start adding a huge amount of that over the next 1 to 3 years back to their free cash flow, presuming they cut rates. Maybe they don't. Maybe inflation takes off. Maybe they keep rates high. Maybe we go into a recession. I don't know. I don't got a fucking crystal ball here, folks. I'm just doing my best with the information that I have. And I feel like this is the most safest, easiest way to collect income and growth and outperform if you're buying these things at the right price points. And I will be a proof of an example of this, because obviously I'm sharing with you the performance, and because I switched from some of these tech stocks like Tesla into these dividend ETFs that are now performing better than these tech stocks, there's a good chance I'm going to outperform this month again. And I'm not a genius here, folks. I just kind of get agitated when I listen to all these opinions and all this fear-mongering and all this bullshit, when all I've done for 10 years now is cost average, buy good companies, take profits, and it worked out. And you could do the exact same stuff without taking a huge amount of risk, in my opinion. But that is my opinion. I am a clown, but a fool on the internet amongst many of the influencer clowns. I'll admit it, and I bet you their price performance returns aren't nearly as good as mine. And I'm not trying to do that as a brag. I'm just saying, hey, maybe, just maybe this clown knows what he's doing. Do you know what you're doing? I'd love to hear about it in that comment section below.